look at the pre-market futures data this morning, and you can practically feel the global financial system just holding its collective breath.
Yeah, the tension is definitely palpable today.
I mean, it is Wednesday, June 17th, 2026, and we are staring down this highly detailed institutional strategy roadmap.
Right, a roadmap that is showing billions of dollars rotating across sectors overnight.
Exactly. We basically have two massive global narratives colliding in real time, and, we're standing at the absolute starting line of a whole new era for the U.S. economy,
We really are. We're sitting on a macro powder keg right now.
which is wild to watch.
It is. And institutional money managers are scrambling to position themselves before the match is lit at 2:00 p.m. Eastern today.
So the goal of this deep dive is to help you, the listener, look under the hood of today's pre-market data.
Right, because glancing at the broad indices just isn't going to cut it today.
Not at all. We want to understand exactly where the smart money is moving and, well, more importantly, why it's moving there.
Let's get into it.
Okay, let's unpack this. The most immediate catalyst driving this morning's tape is actually overseas,
Yeah, Brent crude oil just plunged below $80 a barrel.
which is a huge psychological level to break.
Absolutely.
And this massive drop is being driven by rising optimism over an interim peace deal between the U.S. and Iran.
Right, which the street is expecting to be signed this Friday.
Yeah. And when oil drops below that $80 barrier, the ripple effects are pretty much immediate.
Well, crude is the baseline cost for moving literally every physical good on the planet.
Exactly. So when fuel costs plummet, global inflation fears instantly ease.
It acts as an immediate tax cut for the global consumer.
Right. And a margin boost for logistics and retail.
And the broader market is reacting aggressively to that relief. I mean, the Dow Jones just pushed to a fresh record of 51,999.67.
Literally a hair away from 52,000.
It's incredible. We are seeing institutions pour billions into financials, energy, and old-school industrials.
But at the same time, and this is the part that's fascinating, they're violently rotating cash out of mega-cap tech and chip stocks.
Yeah, which is what dragged the Nasdaq down over 1% yesterday.
Right. And wait, this is where I struggle with the narrative.
Okay, lay it out.
If oil is driving, right, and systemic inflation fears are easing, shouldn't tech be partying?
You would think so, yeah.
Because lower inflation generally translates to lower interest rates down the line, which high-growth tech relies on.
Right.
So why is institutional cash fleeing to old-school industrial stocks instead? It feels mechanically backward.
Well, what's fascinating here is that it seems counterintuitive until you factor in the second narrative.
Ah, the unknown variable.
Exactly. The ultimate unknown hitting the market today. At 2:00 p.m. Eastern, newly appointed Federal Reserve Chairman Kevin Warsh makes his debut policy decision.
And the baseline interest rate is widely expected to hold steady, right? Like between 3.50% and 3.75%.
It is expected to hold, yes. But the real anxiety surrounds the fact that we just printed a 3-year high CPI inflation reading of 4.2%.
Oh, man. So all eyes are going to be on his dot plot.
Precisely. Institutions aren't rotating out of tech because they suddenly hate growth.
Right.
They are rotating out because tech is highly expensive, richly valued, and therefore incredibly vulnerable.
So they're basically just playing defense.
Exactly. A classic risk-off maneuver. Tech has generated massive returns for these funds.
Yeah, so with a brand new Fed chairman step into the podium after a hot inflation print.
They are taking those massive profits off the table.
Makes sense. And they're parking that cash in cheaper cyclical value stocks like the Dow Industrials, just to weather whatever volatility Warsh triggers.
Right, because the street is terrified that Warsh might feel the need to prove his inflation-fighting credentials on day one.
To show he's tough on that 4.2% print.
Exactly. If he dismantles the previous dovish timeline, the mathematical foundation supporting those high-tech valuations instantly fractures.
So institutions hide in industrials because those companies trade at lower multiples.
And they pay dividends, which provides a cushion if the broad market drops.
Okay, so that defensive posture leads logically into how the major indices are behaving right now.
It does. If you look at S&P 500 futures forward/ES, they're up a very muted 0.28%.
And the institutional roadmap gives us a line in the sand support at 7,500.
Right. If the market cracks below 7,500 and holds it, the floor essentially falls out for the near-term bullish trend.
Well, on the upside, they're facing a heavy resistance ceiling roughly 100 points higher at 7,628.
Now, over on the Nasdaq 100 future side, the picture is even more precarious.
Yeah, forward/NQ. They're attempting to claw back a fraction of yesterday's brutal losses, up about 0.8% in the pre-market.
But they are entirely dependent on holding the 30,000 level.
That 30,000 mark is the critical institutional floor.
Yes. If volume pushes it below yesterday's low, the panic selling will likely accelerate.
And complicating all of these technical levels today is the fact that it is CME Roll day for the second quarter.
Oh, right.
Meaning systematic funds and large institutions are mechanically forced to transition their expiring futures contracts.
They're selling the expiring June contracts and buying the September ones.
Exactly. Which creates this massive amount of artificial volume that completely masks true directional intent in the market.
Which is why the institutional roadmap labels this morning's pre-market session a liquidity trap.
A liquidity trap, I like that term. Because the entire market is paralyzed, waiting for the 2.0 p.m. Fed announcement, genuine directional volume is extremely thin.
The big players are just sitting on their hands.
Right, and when volume is thin, the market becomes highly susceptible to algorithmic stop-ons.
It's brutal out there.
I mean, it sounds like a tourist trap in a foreign city. You know, early buyers are basically tourists getting lured down a deserted alleyway by algorithmic stop hunts, just waiting to get fleeced before the Fed announcement.
That is a highly accurate way to look at it. Market makers intentionally build these liquidity pockets
To flesh out weak hands.
exactly, to flush them out before committing real capital. They can see the order books. They know there are clusters of retail stop-loss orders sitting just below big psychological levels.
Like that 30,000 mark on the Nasdaq.
Right. And because liquidity is so thin, it takes very little capital for a market maker to push the price down, trigger those stops, and cause a cascade of forced selling.
Then they swoop in, buy the discounted shares, and use that manufactured liquidity to fill their own larger orders before the bell.
Which is why we advise you not to chase early breakouts this morning. Let the algorithms hunt, let the dust settle from the Warsh announcement, and keep your capital protected.
Good advice. But, you know, despite those tourist trap dangers, tech is actually showing some life today.
It is, yeah.
We're seeing some specific tailwinds lifting the Nasdaq. First off, the 10-year Treasury yield has cooled down to 4.43%.
Pulling back from its recent high of 4.67%.
Right. And adding to that, the U.S. dollar index, or DXY, is dropping toward 99.5.
Because of that Iran deal reopening the Strait of Hormuz, reducing the need to hoard U.S. dollars as a safe haven.
Exactly. Now, I always visualize the 10-year yield as like gravity.
Oh, that's a good analogy.
Yeah, when gravity weakens, like yields dropping to 4.43% today, high-growth tech naturally floats upward.
Because institutional models use the 10-year yield as the baseline risk-free rate to discount future cash flows.
Right. Lower yield equals a lower discount rate, which mathematically inflates the present value of tech earnings.
And a weaker dollar is a massive hidden earnings boost for mega-cap tech.
For sure. If Apple sells iPhones globally in euros and yen, a weaker dollar means those foreign currencies convert into significantly more U.S. dollars on their earnings reports.
It's a powerful 1-2 punch for the Nasdaq.
But the semiconductor sector isn't just floating today, it's surging.
Oh, heavily.
The SOXX ETF is up 3%, Micron is up 5.16%, AMD is climbing near 3.8%.
And a lot of that points directly to Honolulu.
Right, the VLSI Symposium. Intel just made a massive announcement.
Their next-generation 18AP process node has officially entered risk production on schedule.
Which is huge. They claim it delivers a 9% performance bump.
Or an 18% reduction in power usage.
But wait, let me push back here. Is Intel actually pulling the whole semiconductor sector up with real tangible innovation? Or are they all just floating because the macrogravity changed?
Well, I'd say it has to be a synthesis of both.
Okay, break that down.
The macro environment, that 4.43% yield, that opens the door. It gives institutions permission to buy.
Right.
But a multi-billion-dollar rotation into a specific sector requires tangible proof of execution. Intel proving they're hitting scheduled deadlines on their massive foundry turnaround, that provides the justification.
Especially with the rumor mill spinning that hitting this milestone is exactly what Intel needs to snag Apple's foundry business.
Exactly. They aren't just selling a narrative, they are manufacturing the silicon, and institutions demand that level of execution.
Well, speaking of execution, let's pivot from the broad macro moves to two entirely unrelated companies that are completely ignoring that macro noise today.
The idiosyncratic outliers.
Yes, from space to sofas. First up, SpaceX, ticker SPCX. They've been dominating since their June 12 IPO.
And their options market just debuted with a record $2.8 billion in premium.
Which is staggering. The bull level to watch there is $225.64, by the way. But they also just confirmed a $60 billion all-stock acquisition of Cursor.
The AI coding startup.
Right, to power their XAI division,
Hmm.
which at first made me think, why does a rocket company need a $60 billion software coding startup?
It sounds strange at first.
But modern aerospace is entirely dependent on autonomous systems. Landing boosters on drone ships requires millions of lines of telemetry code.
Code that needs to be generated, simulated, and debugged continuously.
Exactly. Integrating an AI coding engine allows them to iterate exponentially faster.
The market is valuing that as a massive leap in efficiency.
Now, on the exact opposite end of the spectrum, we have La Z-Boy, ticker LZB.
We are literally looking at Mars colonies and reclining sofas in the same breath.
I know, it's hilarious. But La Z-Boy is soaring 12% to around 39.45 cents in the pre-market.
They completely crushed Q4 EPS estimates. $1.26 versus 82 cents.
They authorized a $300 million buyback, and operating margins hit 9.9%.
Yeah.
Which leads to my question. How is a furniture company seeing this kind of surge when the broader macroeconomic trends for consumer goods are supposedly soft?
Well, this really highlights the beauty of stock picking in a volatile market.
Right.
La Z-Boy achieved this by ruthlessly optimizing their own mechanics. They deliberately shed underperforming wholesale lines.
Oh, so cutting out the third-party dealers who take a cut of the profit.
Exactly. By aggressively expanding their own dedicated retail stores, they captured the entire profit margin for themselves.
Hence the 9.9% operating margin. So
Yeah.
institutional money will reward execution, regardless of what the Fed is doing.
Precisely.
But, it's easy to look at Intel and SpaceX and get overly optimistic. The source material contains a glaring warning for the listener today: the pain trade.
Yes, and if we connect this to the bigger picture, this is arguably the most critical macro concept for an individual investor to grasp right now.
The warning centers on retail investors who are currently heavily leveraged in high-multiple AI tech ETFs.
Because they assume the Fed easing cycle is going to be perfectly smooth.
Right. But if the 10-year yield violently spikes, say, because Warsh comes out hawkish at 2.0 p.m. cheap debt vanishes.
And those tech giants will suddenly have to self-fund their massive AI capex build-out. Data centers, power grids, liquid cooling.
Out of their own cash reserves, which crushes profit margins.
Smart money knows this and will dump high multiple growth names. The retail investor holding the AI ETF becomes the exit liquidity.
Ouch. And it gets worse because of something called the correlation pincer.
Right, where stocks and bonds sell off together.
Yeah. You might think your 60/40 index fund is a safe, diversified life raft. But what happens when the water and the raft are both sinking at the same time? How does an everyday listener protect themselves against this?
The transition to the Warsh Fed means the margin of error for tech valuations is razor thin. You have to practice strict critical thinking. Keep stop losses tight, and whatever you do, do not treat tech as a default safe haven.
Great advice. Okay, briefly recapping today's roadmap. We are navigating a pre-market liquidity trap defined by algorithmic stop hunts.
So keep your hands off the keyboard early.
We are tracking a massive rotation to cyclical value triggered by falling oil and dropping yields.
And obviously watching Kevin Warsh's debut dot plot at 2:00 p.m. Eastern.
Exactly. But before we wrap, I want to leave you with a final thought to mull over, building on that AI capex warning.
Okay, what is it?
If the AI revolution requires an unprecedented amount of physical infrastructure, millions of miles of new copper wiring, new substations, massive baseload energy generation, maybe the true tech winners of the next decade won't be software companies at all.
Oh, wow. That's a great point. The ones building the foundation rarely get the headlines.
Right. Maybe the real winners will be the unglamorous utility, energy, and industrial companies that actually build the infrastructure. So ask yourself, are you looking in the wrong sector for the next big tech boom?
Something to carefully consider today.
Definitely. Stay sharp today. Watch the data at 2:00 p.m. ET, and we will catch you on the next deep dive.